Hi, everyone. Welcome to the Real Vision Daily Briefing. Andreas Steno from Real Vision speaking, and we are live Tuesday, 8th of November. We have a lot of action to unpack today, not least in the bleeding crypto space, which is why I have my colleague Ash Bennington with me. First of all, good to see you, Ash. A sudden liquidity crunch at the FTX crypto exchange. Binance apparently stepping in to underpin FTX with a pending DD before a takeover. Please take us through what happened earlier, Ash, and how you perceived the events as they unfolded.
Oh, that's exactly right, Andreas. I mean, the first thing to say is it's just been an extraordinary day in the crypto space. So this story goes back about a month when Bloomberg wrote a story about the interrelationship between FTX, obviously Sam Bankman-Fried's exchange, and Alameda, Sam Bankman-Fried's trading company, crypto quant shop, crypto prop shop, for lack of a better term. Obviously, Sam owns very large percentages of both. The exact numbers are not known. But about a month ago, this story came out in Bloomberg talking about the interrelationship, the economic interdependencies between those two firms. Last week, CoinDesk followed up on that story and wrote in more detail about how Alameda, the crypto prop shop, owned a great deal of FTT. This is the FTX native token, the token that is essentially, we can assume, reliant to a certain extent on the cash flows of FTX, and then also provides trading discounts for FTX users. So there's some utility function of that coin as well. And then a couple of days ago, we saw this Twitter spat break out between SBF and CZ, two men known by their initials, Sam Bankman-Fried and Shenzhen Powell, from Binance. So this dispute started sort of out of nowhere, and then today, after this sort of intense conversation, I should add that what was the sort of the trigger for this was CZ came out with a statement that he was going to be liquidating, I believe it was $500 million in FTT tokens. They were the first investor. Binance was the first investor in FTX, and they announced essentially that they were going to be liquidating that token. Then you have this conversation, this rather heated debate in the Twitter sphere between CZ and SBF. And then today, 24 hours after this had sort of flared, you have this announcement from Sam Bankman-Fried that FTX, all of the non-US operating entities, which I believe is the bulk of the company in terms of transaction volume, is going to be sold to CZ and Binance. Just an extraordinary sort of chain of events here in the last 24 hours.
What's the talk of the town in crypto space after this deal has been announced, Ash? I mean, a liquidity crunch is obviously a word that most investors don't like to hear.
Right.
Is it a market full of scared market participants now?
Well, what had happened, what really caused this most recent round of today's chaos was the challenges that they had in meeting redemptions, essentially giving customers back their money when they wanted to sell their crypto. They got lagged in that, and they obviously needed to raise a great deal of money. This idea of a liquidity crisis, a single firm liquidity crisis, is when you have, in theory, you have assets, but you're not able to sell those assets in time to meet your obligations. So you have this mismatch between assets and liabilities. And when this happens, it can be potentially catastrophic. Lots of people remember these things happening on Wall Street in 2008. I said on Real Vision Crypto Daily Briefing today, maybe this wasn't a Lehman moment for the space, but it was kind of a Bear Stearns moment, or a Bear Stearns moment on blotter acid in hyperdrive because of the speed at which all of this occurred in. But, obviously what's interesting about this is as the news broke earlier today, we didn't see a whole lot of movement in Bitcoin and Ethereum. And now I'm looking at my screen. There's just a lot of red on the screen right now. Bitcoin now trading below 18,500, off on a trailing 24-hour basis, about 12.25%. So it's lost nearly 12.25% in the last 24 hours. Ethereum, below 1,500 now, key psychological level, now trading at 1314 on my screen, off nearly 18% on a 24-hour basis. Solana is getting absolutely hammered on this. Solana being part of the collateral that was involved in some of the FTX properties. Right now, looks like off more than 25%, trading at 23.85 on my screen. So obviously some negative price momentum action on this news. But, you know, I think the bigger questions here are the philosophical ones that this has begun to raise. And I think that that may be sort of the longer term result of this is what happens when you like to Wall Street firms. These kinds of conversations are conversations people who were watching the space in the 2007, 2008 era remember only too well, with Bear Stearns, with Lehman Brothers, and some of the other shops that failed. So what's interesting to me is, you know, in many ways, the crypto space was sold to us, to people out there who were interested in it, like myself, as something that was going to be much more secure, much more transparent. And yet, when you have these centralized entities, you basically are relying on the trust of human beings that people have in human beings. I can hear myself. I've just had a conversation on Twitter Spaces with Jim Bianco, and I think I've imbibed some of his ideas about this. He was talking very passionately about this idea of what happens when trust collapses. But that's fundamentally what we had. You could talk about this in terms of Voyager. You could talk about this in terms of Celsius. You could talk about this in terms of Luna. These are all conversations that the idea was that when you lost faith, when markets lost faith in the credibility of an institution or in the credibility of a peg, that you saw these dramatic downward momentum in the asset price valuations. And this is really, I think, the philosophical question about what's happening in this space right now when you have these centralized entities like an exchange that control so much power. Obviously, Sam Bankman-Fried, one of the wealthiest people in the world prior to today, and someone who is an incredible powerhouse in the space until these extraordinary, just extraordinary events of the last, whatever it's been now, less than what, 6 hours? It's been incredibly quick.
It leads me to the million-dollar question, if not the billion-dollar question of the day, Ash. How severe is the contagion risk from this event?
You know, I think the only truly honest answer for that is we just don't know. The animal spirits of markets are obviously can be very skittish at times. We've seen it's not been a great year for crypto, as anyone who's held these assets knows. When you look at this down from the November 21 highs, Bitcoin was trading at a share at a slight sliver below $70,000. And now, here we are trading down at 18,000. So the extent to which markets can continue to get more skittish, an open question. I think the only real answer right now is when you find yourself at one of these inflection points, it's just uncertain. There's a tremendous amount of uncertainty in the space. That's how I would characterize it. Very difficult to know, obviously, the future price action on this.
Jared, I wanted to bring in your views on this as well. Is this symptomatic of the kind of marketplace that we're seeing across assets these months?
Well, I mean, it kind of reminds me of 2008, to be honest. I mean, there was a series of failures in 2008. Washington Mutual, Countrywide, Merrill Lynch, Bear Stearns, and it culminated in Lehman. And Lehman was the last and the biggest failure. And, when I think about the failures in crypto over the last 6 months, whether it's Luna or FTX, really I think the last domino to fall is MicroStrategy. I think if MSTR were to fail, that would definitely mark the bottom for crypto. And the other interesting side effect to this is, Coinbase being a regulated U.S. exchange, stands to benefit a lot from this. They are regulated in a way that the other exchanges aren't, and have the ability to steal some market share for the next bull market, and there will be another bull market someday.
I wanted to play a soundbite for you from our daily crypto briefing from just earlier today, obviously hosted by you, Ash. So let's listen to the soundbite and get back to this discussion.
Yeah, I mean, my mind is really blown at how rapidly this story developed. I would say, obviously, there's a lot of information that is unknown still, and all we're getting is sort of bits and pieces from different tweets. I will say it's a really fascinating posture, in particular because SBF has been so active in the policy discussion in DC, and now. It might look to many people like the emperor has no clothes. And I do wonder how that's going to frame the discussion in DC going forward.
The daily crypto briefing is available for free at the realvision.com page. But back to you, Ash, since you're the host of the crypto briefing, what's on your radar the coming days after this event?
Well, I can't really comment on the clip because I couldn't hear the audio. The only thing I can say definitively is today's obviously not the kind of day where you change your shirt between shows. Look, I'm gonna point to the obvious here. Here's what I'm gonna be looking at. Obviously, we're gonna be looking at price action. We're gonna look to see to what extent this is going to impact Bitcoin and Ethereum pricing. We're also looking at Solana. Let me pull up, by the way, another aspect of this that's really quite stark today is the absolute collapse in FTT. This is the native token of FTX. It started the day out at about $22, and now it's trading at $5.59 on my screen. So obviously we're going to be looking at the price action, and clearly we're going to be following Sam Bankman-Fried's Twitter feed very closely. He posted, and if you go ahead and watch that show, and I'd encourage everyone to go out and take a look at Real Vision Crypto Daily Briefing today. So the main primary source of information that we had during today's conversation, CZ from Binance put out a relatively modest, kind of very direct statement on Twitter. But Sam Bankman-Fried really unpacked this in some detail. And on that show, with the two terrific guests we had, and with our own Marco, we went through and walked through those tweets at a very granular level and talked about exactly what Sam was talking about in those tweets and why it may or may not be significant. Obviously, it's incredibly early in the story. We're just trying to look at the facts that we have on the table and maybe try and analyze them a little bit. But that's what I'm going to be looking for. I'm going to be looking to see if there's any new news flow out of SBF's Twitter feed, because that's been the most powerful source of information. In fact, 99% of the stories that you're going to see written about this are going to use Sam Bankman-Fried's Twitter stream as the source material. So we're going to be waiting to see if we hear anything more from Sam, and also, of course, looking at price action to see if there are any contagion effects. Andreas.
Ash, thanks so much for joining us this afternoon. Always a pleasure to get an update from you. Jared, I wanted to get back to you and sort of the feelings that we get when we watch this kind of price action in crypto space, but also with certain spillovers to other parts of the asset markets. You wrote a story in the Daily Dirt app today on the resemblance to the .com experience. So tell us a bit about that story and what feels so reminiscent to the .com crisis today.
Well, I think there's a lot of analogs between what happened from 2000 to 2003 and what's happening today. The NASDAQ over that time period was down 80%. But once the bear market ended, you had really a renaissance in value stocks. You had a regime shift from growth investing to value investing. And if you look at what's happened in the markets over the last, I would say 4 or 5 weeks, value has outperformed pretty strongly. One of the best performing sectors has been industrials, actually. And I'm starting to draw some conclusions about how we might be entering, and people have been waiting for this for 15 years. I mean, people have been saying that value investing is dead. It's never coming back. And in the last month or so, it's coming back. And it feels a lot like 2003. I mean, I remember I was on the trading floor in Lehman, and, instead of hearing orders to buy Microsoft or Amazon or things like that, I was hearing orders to buy Phelps Dodge and Cleveland Cliffs and Inco and, basic materials and industrial stocks. And that's really what led the market out of the bear market in 2003. And it kind of feels like the same thing is happening today.
Let me show you a chart I made on the NASDAQ index versus the .com experience. It's chart 3, Brian. It's obviously not a serious price prediction, but it works as a decent historical analogy. And if this is the .com all over again, it may take the NASDAQ basically more than a decade to really gather pace again. If you look at the price action and basically copy paste it from 2002 and onwards. Do you think it could take another decade before we start talking up tech again? I mean, is it that severe?
No, I do think it is, and I don't say that from like a place of bearishness. I'm not saying that as like a perma bear on tech. The reason I say that is because in markets, like the same gag never works twice in a row. It's always something different. Like things change. So, whatever leads us out of this bear market is not going to be tech. So there's a lot of discussion about Facebook. Facebook is down 72% and Google is down, I don't know, 30 or 40%. And people are looking at these tech stocks and trying to pick bottoms, but that's a huge waste of time. We could have a very long period of time, maybe not 10 years, but at least 3 to 5 years where tech doesn't really go anywhere and those valuations compress. So, yeah.
Jared, I consider you basically the master of sentiment assessment. And if we look at the current sentiment in the tech space, in the crypto space, etc., is it something that would worry you when you conclude that the tech sector is not a buy currently?
No, I wouldn't say it worries me. I mean, look, I think we're getting down to the tag ends of the bear market. I think it's, the way I look at the bear market is, people think that it began around January of this year, but I think it actually began around January of last year. I think the peak in sentiment in the market was actually the GameStop incident. That actually was the peak of sentiment in January of 2021. So if you use that as your starting point for the bear market, this bear market has lasted almost 2 years, and the average duration of a bear market is 20 months. So this has already gone on longer than normal. So, like I said, I think we're getting down to tag ends, but instead of focusing on the stuff that's not working and hasn't worked, you want to focus on the stuff that is working and will work in the future.
We already get a lot of questions in from the audience, and we have a question from our member Russell. He wants you to give an update on your sort of broad-based assessment of the sentiment across assets at the current juncture, Jared. So please go ahead.
Well, with stocks, we put in a low of basically 3,500 in the S&P to the tick on Thursday, October 13th. That was the last CPI print. It was the number we expected was, I think, 8.1. It came in at 8.2%. We had this big sell-off in the morning. We put in the bottom at 3,500, and then we had a big reversal intraday. We have had a period of a couple of months now where we've had repeated attempts to get back down to those lows, and a lot of bad stuff has happened in the markets. And you know what they say, when you have bad news and the market can't go down, it usually means that we're going to have a bull market. I mean, it's just kind of trading wisdom. So we have CPI obviously on Thursday, and we're expecting 7.9%. One of the things that people have been talking about with CPI is that even if we're having marginal increases in inflation on a month-over-month basis, the headline number is going to come down over time. We're expecting 7.9%. I think if it comes in at 7.9%, that is a victory. I think there's a possibility it could come in below that. And if that happens, we are going to have an explosive move to the upside. I think it's very asymmetric. I don't think we have a lot of downside. Let me put it this way. I don't think we have a huge amount of downside on a number that prints 8% or higher. I think it's already priced in.
Let me show a couple of charts on inflation that I wanted to share with you, Jared. I think the two of us share the view that inflation is about to come down. And I have a couple of interesting charts in relation to goods inflation in the US. First of all, it is fairly clear that the inflation stemming from the supply chain of China is starting to fade. If we look at the freight rates from China to the West, they're basically falling off a cliff week after week right now. And you get a pretty neat correlation to the price of goods in the PCE basket or the CPI basket with the time lag. That's one interesting observation. And then chart one, Brian, on the Manheim index, so the used car index versus the price of used cars in the CPI index. The Manheim index is now in deflationary territory. So prices are falling week after week on used car auctions. So goods inflation coming down. But the big question now, Jared, is probably the service sector. So what do you make of that dynamic?
No, I saw your post on Twitter about that the other day about goods inflation versus services inflation. And goods inflation definitely is going to come down. Services inflation will come down more slowly or not at all. because most of that is based on wages, and the labor market is still strong, and wages are sticky, and there's a whole bunch of reasons why service prices won't come down. So the thing that kind of sticks with me is, the Fed has what you are giving us today are private real-time measures of inflation. And the Fed has access to the same data that you or I do. They have lots of private real-time information on inflation. But they act as if the only piece of information they have is CPI. And CPI doesn't tell you what's happening today. It tells you what happened 4 months ago. So, 4 months ago, we printed 9.1%. And that was basically coincided perfectly with, Jerome Powell saying that inflation was not transitory. So I think, after 4 months have passed, I think we're going to start to see some of this feed into CPI. The disclaimer is I've been saying this for a couple of months and I've been wrong, so I feel kind of foolish about it, but I do think it's going to happen soon, possibly at this number.
Yeah, welcome in the club. I've done the exact same thing, Jared, to be brutally honest. The last time the two of us spoke on the Real Vision Daily Briefing, you had some hilarious remarks almost on the sentiment within the long commodity bet. You basically addressed it as one of the most cocky sentiments you'd ever seen, due to the traders being long energy not really reflecting on the price action we'd seen in the oil price at the time. So what do you make of the sentiment in energy space right now compared to a couple of months ago?
I mean, sentiment in the energy space kind of goes back and forth between hot and very hot. It doesn't really cool off. People are bullish on oil, or they're very bullish on oil, or they're extremely bullish on oil. I'm not really fighting the sentiment in energy these days, because there's a lot of good fundamental reasons why you want to be long oil. And the first of all is that we're running, the SPR releases are tapering, right? So we're getting down to the ends of the SPR releases. And the second of it is just the overall psychological impact of President Biden's just complete intransigence on drilling. So like literally saying, read my lips, no drilling. I mean, the psychological impact of that is super, super powerful. So I have a tough time being bearish on energy at this point in time.
We obviously have the midterms today in the US. We don't know the result yet, but is the midterms a potential game changer for this whole energy trade? The idea that the scarcity will remain a thing into next year in the US.
Well, I don't think the midterms really have an effect on energy. I think they do have an effect on overall sentiment. This is going to be falsifiable in a couple of hours, but I do believe that the Republicans will take the House and the Senate. The last betting prediction odds that I saw was that the Republicans had an 80% chance of taking the Senate. So I think it's fair to say that's probably going to happen. I think I would expect to walk in tomorrow and find futures up. Now, I've seen some arguments that a Republican win is actually bearish equities, and the reason people are making those arguments is because of the Keynesian impact on spending. So what we're going to have is a complete, basically halt to new spending over the next 2 years. And I would interpret that as bullish, especially for bonds. I mean, from an academic standpoint, if you have less bond issuance, I think it's positive for bonds, and I think interest rates come down. But some people look at that from a Keynesian standpoint, and they say, well, we're not going to have as much spending, which is going to result in lower growth. And, you can look at it either way.
Fair point. But given this interesting discussion on spending, I wanted to get your take on today's price action in both interest rates and also in gold. It seems like an interesting cocktail. We have gold prices up, bond yields down, alongside this meltdown in crypto space. So what do you make of that price action also in relation to this discussion on spending post the midterms?
Well, I mean, really, the gold trade, I think, is kind of divorced from fundamentals. I mean, what I'll say about I'll say about gold what I say all the time is that it really trades technically. And what we had today was a breakout above trendline resistance. We had an 8-month downtrend from the 2060 highs back in March, and we just broke above the downtrend today. And if gold gets above 1720, which is the previous highs, that's where we ran into resistance today. If it gets above 1720, then basically the whatever you want to call it, the correction or bear market in gold will be over. So that could happen soon. An interesting thing I noticed about the markets today is that in the afternoon, when stocks were cratering on the FTX news, the bond market held pretty firm. And what you've been seeing in the last several months is a positive correlation with stocks and bonds. And today, for the first time, you actually saw a negative correlation with stocks and bonds.
Yeah, interesting observation. Let's conclude with a couple of questions from our members. We have a question from Scott asking you whether you expect contagion effects from the crypto washout to NASDAQ, basically. Are there crypto-related stocks in the triple Q index that you should be aware of?
I don't know about contagion. Look, regardless of what happens with FTX, I made the argument earlier that I expect tech to underperform, right? So, if we get a 10% move higher in stocks, you're probably going to get a 5% move higher in tech. I just think it's going to underperform.
A question from our member, Gary. He's asking you for a potential driver behind the performance that we've seen in industrials over the past 6-8 weeks here. Dow Jones performing well versus NASDAQ, for example. He referenced the huge driver when China entered the World Trade Organization in 2001 and the subsequent performance in industrials relative to other parts of the equity index. Do you see sort of a fundamental driver behind this time around?
That's a pretty smart comment. It's funny. I never drew that connection between China in 2001 and industrials. No, I really think it's more of a function of quants, really, and factors and trading factors. You've probably seen over the last 6 months a pretty strong negative correlation between energy and tech. Right, that's all quant trading. That's all factors, and the value factor has, for reasons that I don't know or understand, has come back into favor. I don't know that I really care why, but if you look at the historical parallel between today and 2003, and you think that can persist into the future, then you want to follow that higher. There's all kinds of evidence. There are cheap stocks all throughout the world. Europe, I've said this a bunch of times before. Europe is trading like 1982 in the US. You have single-digit PEs, you have high dividend yields. Emerging markets, you have just enormous dividend yields in emerging markets. Like, there's a lot of cheap stocks in the world. And US stocks are much more expensive, but there's a lot of opportunities everywhere.
Yeah, and I may raise the flag for Europe being one of those continents with very cheap equities as a consequence of the ongoing energy crisis. Jared, let me try and summarize for the audience here. First of all, in relation to the initial discussions on crypto, it's basically too early to say whether the contagion risk is large or not, but it's certainly not good news for the crypto space. And I mean, one probably shouldn't rule out spillovers to the broader tech sector. And with your words, you're basically already ready to underway tech stocks versus the rest of the equity space. So I guess this is just another reason to do so. Value is back in fashion, and it seems kind of reminiscent of the post-2002, 2003 experience. So let's see whether we will get a complete copy-paste of the subsequent 10 years after the dot-com crisis. In case, it will be very interesting to follow. Jared Dillian, it was a pleasure to host you.
Yeah, thanks. Thanks for having me on, and I'll see you soon, hopefully.
I'll see you soon, Jared. And we will obviously be back tomorrow with more in the daily briefing. But before I leave you, here's the meme of the day. And I have to show you this meme again. I've shown this meme to you before, but this is Jay Powell saying, I'm going to hike interest rates until you morons stop trading monkey JPEGs. And that was the reference that I started the whole show with. Thank you for watching the Real Vision Daily Briefing, guys out there. We will be back tomorrow with more. Weston Nakamura will host the show, and he will be talking to Darius. They'll see you tomorrow.